SaaS investors are getting destroyed right now. The software ETF IGV is down more than 30% from the high, and many high-growth SaaS companies are down 40 to 70%. Microsoft, Salesforce, Adobe, the list goes on and on. But the market is making a huge mistake. It's treating every SaaS company like it's the same business. In reality, some of these companies have incredibly strong moats, and others are far more fragile than investors realize. So today, I'm ranking major SaaS companies by moat strengths and valuation to see which ones might be a good buy today. Before ranking these companies, it's important to understand that not all SaaS businesses are equal. Investors often analyze software companies using a framework that divides them into three categories: system of record, system of intelligence, and system of engagement. At the foundation are systems of record. These are platforms that store the core data of a business, things like customer information, financial records, or application databases. Because companies build their operations around this data, switching away from these systems is extremely difficult. That's why these businesses tend to have the strongest moats. On top of that sits system of intelligence. These companies analyze and process data from different systems to generate insights, automation, or security. They can become very valuable, but they usually depend on the underlying data infrastructure. Finally, there are systems of engagement. These tools help people communicate, collaborate, and interact with the software. While they can still be great businesses, they usually have lower switching costs because alternatives are easier to adopt. Now let's jump in and rank the most popular SaaS businesses. Starting from the first company, Palantir Technologies. Palantir builds software platforms that help governments and enterprises analyze massive datasets and make operational decisions. It produces, integrates, and analyzes data across complex organizations. In the SaaS framework, Palantir acts mostly as a system of intelligence, sitting on top of the data infrastructure. The business can be somewhat fragile because the revenue depends on large contracts, but deep integration creates meaningful switching costs. Looking at the valuation of Palantir, currently trades at 223 PE and 75 forward PE with a PEG of 1.9x. Current price to sales is 81, which is significant correction from this 140 price to sales, but currently 80 is still a little bit expensive for the company like Palantir. Price to free cash flow 172, price to operating cash flow 170. From the valuation perspective, Palantir is definitely expensive company. I would rank Palantir in A tier. I think Palantir has deep integration with government and enterprise data systems, which creates very high switching costs. Its platforms like Gotham and Foundry are also positioned to benefit directly from the rise of AI rather than be disrupted by it. The next company is MongoDB, which provides one of the most popular modern databases used to build cloud applications. Developers use it to store and manage applications' data at scale. This makes MongoDB a system of record, since it holds core application data. Databases are extremely sticky, giving the company strong long-term durability. Looking at MongoDB's valuation, currently the company is not profitable. PE is negative, but forward PE is already positive 43, and PEG is 2.3. So actually, from the PEG's perspective, MongoDB is more expensive than Palantir. It's quite mind-blowing. The stock-based compensation for MongoDB is still more than 100% of free cash flow. Price to sales for MongoDB is 8.79, which is quite at the bottom of historical averages, and a medium of 18. So based on the price to sales for MongoDB, we can say that company is quite cheap. Price to free cash flow of 42, I would ignore because how much stock-based compensation they are giving to the employees of the company. MongoDB is one of the most widely used developer databases and is deeply embedded in many applications. Databases are extremely sticky, though large cloud providers offer competing database services. I would rank MongoDB at tier A as well, together with Palantir. From the moat strengths, I believe they are weaker than Palantir, but from the valuation perspective, they are looking cheaper as for now, even though I don't really like the amount of stock-based compensation. The next company is CrowdStrike. CrowdStrike is a cybersecurity platform that protects devices, cloud systems, and identities from cyber threats. Its Falcon platform analyzes massive amount of security data using AI. In a SaaS stack, it functions as a system of intelligence, turning security data into threat detection. The business is strong, though the competition in cybersecurity remains intense. CrowdStrike is not profitable, PE is negative, forward PE 88, PEG 2.9x. From the price to sales perspective, Palantir trades at 22 times sales, which is close to 10 years average. I would rank CrowdStrike at a B tier. CrowdStrike is a leader in cloud cybersecurity with a strong technology, but still, I believe the security market is extremely competitive and constantly evolving. The next company is Cloudflare. Cloudflare operates a global network that improves website performance and security. Its platform protects internet infrastructure and allows developers to run applications at the edge. In a SaaS stack, it sits between infrastructure and intelligence layers. The company has a strong technical moat through its global network, but competes with large cloud providers. Looking at the valuation of Cloudflare, PE negative, company is not profitable, forward PE 146 with a PEG of 5.1x, not cheap from the first look. Revenue is growing exponentially, income is not growing, and free cash flow turned positive. Again, significant amount of stock-based compensation, more than 100% of free cash flow. From the price to sales perspective, Cloudflare is still trading at 33 times with medium of 25 times. So even though software technology sector was sold significantly, Cloudflare is still trading with a premium for their historical averages. In terms of the ranking, I think Cloudflare should be somewhere between A and B. Cloudflare operates critical internet infrastructure, including security, networking, and edge computing. The platform is powerful, but infrastructure competition is intense. And also, I believe the valuation for Cloudflare is too expensive, so probably the B is a better place for Cloudflare. The next company is Atlassian. Atlassian develops collaboration tools like Jira and Confluence used by software teams. These tools help companies manage projects and document knowledge base. In a SaaS framework, Atlassian is mainly a system of engagement. Its products are deeply embedded in the workflows, but switching costs are lower than core infrastructure software. Looking at the Atlassian here, PE is negative, the company is not profitable, forward PE of 11, quite cheap, and the PEG, price to earnings growth, is 0.7x. From the valuation perspective, price to sales is less than 3 times sales with medium of 16 times. So here, significant discount based on the historical averages. I would rank Atlassian at the B tier. They own developer collaboration tools like Jira and Confluence. These tools are widely adopted, but I believe that in AI era, it could be disrupted by other tools, and switching costs I do not think is too strong here. Even though from valuation perspective, Atlassian is cheap here, at least based on the historical averages. The next company is ServiceNow. ServiceNow provides software that automates workflows across large enterprises. Companies use it to manage IT operations, employee services, and customer processes. In the SaaS stack, it acts as a system of record for enterprise workflows. Because these processes become deeply embedded, switching away is extremely difficult. ServiceNow is already a profitable company with PE of 56 and forward PE of 19. Price to earnings growth is less than 1. 0.9x. ServiceNow trades at 7.4x from the price to sales perspective and price to free cash flow of 21 times. I think ServiceNow deserves S tier. ServiceNow runs mission-critical enterprise workflows like IT service management and operations. Once companies build processes on a platform, replacing it becomes extremely difficult. So the moat for ServiceNow is high, switching costs are high, the valuation is expensive but not overpriced. It already corrected based on the historical averages, so I believe S tier for ServiceNow is well deserved. The next company is Snowflake. Snowflake offers a cloud platform for storing and analyzing massive datasets. Companies use it to run analytics and power data-driven applications. In a SaaS stack, it functions as both a system of record and system of intelligence. The platform becomes deeply integrated once data is stored there, creating strong switching costs. Current price to earnings is negative, forward 92 times. Price to earnings growth is 2.6x. In 2020, the company was traded at 220 times sales, and now the company is sold just for 10 times sales. This is another time when we need to remember that valuation matters. I would rank Snowflake at A tier because the company built a strong data platform used for analytics and AI workloads. However, large cloud providers are competing aggressively in the data warehouse market. The next company is Twilio. Twilio provides communication APIs that allow developers to add messaging, voice, and authentication to applications. Many apps rely on Twilio to interact with customers. In a SaaS framework, it sits in a system of engagement layer. However, communication services can be commoditized, which makes the business more fragile. PE 550 times, forward PE 20 times, price to earnings growth 1.1x. There was time when Twilio was traded at 40 times sales. Currently, the company is trading at less than 4 times sales. Another example why valuation matters in investing. I would rank Twilio at C tier. The company provides communication APIs for developers, but messaging and communication infrastructure is becoming more and more commoditized. The next company is UiPath. UiPath develops robotic process automation software that helps companies automate repetitive tasks. Its tools replace manual processes with software bots. In a SaaS stack, it sits between automation and intelligence layers. The opportunity is large, but the market is becoming more competitive with AI automation platforms. PE 18, forward PE 13, price to earnings growth 1x. Price to sales for UiPath is 3.35x, significantly lower than historical averages. I would rank UiPath at the D tier. UiPath focuses on robotic process automation, which AI agents could potentially replace. As AI becomes more capable, traditional RPA may lose relevance. The next company is Datadog. Datadog provides observability tools that monitor cloud infrastructure and applications. Developers use it to track system performance and detect issues. In a SaaS framework, it acts as a system of intelligence, analyzing operational data across the tech stack. As cloud complexity grows, these tools become increasingly valuable. PE of almost 400 times, forward PE 44, price to earnings growth 2.0x. Price to sales for Datadog is 12 times, comparing to medium of 20 times for the last 6 years. I would rank Datadog at the B tier. The company provides observability tools for monitoring cloud systems. The business is strong, but AI may automate many monitoring and troubleshooting tasks. The next company is DocuSign. DocuSign allows businesses to sign and manage contracts digitally. Its software became widely adopted as companies moved towards digital workflows. In a SaaS stack, it sits in a system of engagement layer. However, digital signatures have become somewhat commoditized, making the moat weaker. Price to earnings of 39, forward price to earnings 11, price to earnings growth of 1.3x. During 2020 lockdowns, the company was trading at price to sales of 40, and now the company is sold at price to sales of less than 3, significantly lower than historical averages. I would rank DocuSign at C tier. The company dominates in e-signatures today, but digital signatures are increasingly becoming a basic feature in many software platforms. The next company is Okta. Okta provides identity and access management software that secures login systems for applications and employees. Its platform controls who can access company systems. In a SaaS framework, it sits close to a system of record for identity infrastructure. Security and identity are critical functions, creating strong customer retention. Looking at the valuation of Okta, 55 PE, 20 forward PE, price to earnings growth of 3.1 times, price to sales 4.4 times sales, significantly lower than 10 years averages. I'm ranking Okta at D tier. Okta leads in identity management, but authentication is increasingly being absorbed by cloud platforms and operating systems. Even though valuation seems cheap, but I believe the moat of this company is relatively weak. The next company on the list is Autodesk. Autodesk develops software used by architects, engineers, and designers to create digital models. Products like AutoCAD and Revit dominate many professional design workflows. In a SaaS stack, it acts as a system of record for design data. Once projects are built on Autodesk tools, switching becomes extremely difficult. The company is already profitable with price to earnings of 43 and forward price to earnings as 20x with PEC of 1.5x. Price to sales is 6.73x comparing to medium of 10.76x for the last 10 years. I'm ranking Autodesk at A tier. Autodesk software are deeply embedded in the engineering and construction workflows. The moat is strong, but AI could eventually transform design tools. The valuation makes sense though, so I think A tier is deserved for Autodesk. The next company is Microsoft. Microsoft is one of the largest software companies in the world, offering cloud infrastructure, productivity tools, and enterprise platforms. Products like Azure and Office power businesses globally. In a SaaS framework, Microsoft spans every layer of the stack. Its ecosystem creates enormous switching costs and durability. If you want the access to InvestKit, we are doing A/B tests now, and all the premium features are available for free. We have advanced projections, reverse DCF, earnings calendar, chart builder, where you can build any kind of chart, compare multiple companies, you name it, screener to find hidden gems. The link will be in the description below. Microsoft is trading at 23 times a PE, forward PE of 19 times, and for the Microsoft, I believe price to operating cash flow is the best valuation metric because Microsoft is investing significantly in capital expenditures. 17 times currently, comparing to historical averages of 23 times, is cheaper comparing to 23 times historical 10 years average. I'm ranking Microsoft at S tier. Microsoft sits at the center of enterprise IT with Windows, Azure, Office, and developer tools. AI will likely strengthen its ecosystem rather than replace it. The next company is Salesforce. Salesforce is a leading customer relationship management platform. Companies use it to track sales, marketing, and customer interactions. In a SaaS stack, it's a system of record for customer data. Its deep integration into sales processes creates strong long-term retention. PE of 22 times, forward PE of 13 times, price to sales corrected significantly from 12 times sales to now less than 4 times sales. I'm ranking Salesforce at A tier. Salesforce is a dominant CRM platform with huge switching costs. However, AI agents could eventually change how companies manage customer data. The next company is Adobe. Adobe develops creative software used by designers, marketers, and content creators. Products like Photoshop and Illustrator dominate digital design workflows. In a SaaS framework, it functions as a system of record for creative assets. Its strong ecosystem creates powerful switching costs. Adobe currently sits at PE of 13.7x, forward PE of 9.1x, and price to earnings growth of laughable 0.8, price to sales less than 4, and price to free cash flow is less than 10. I'm ranking Adobe at S tier. I believe Adobe owns the creative industry standard with Photoshop, Illustrator, and Premiere. Even AI design tools usually integrate directly into Adobe's ecosystem. I did a whole video about Adobe and explained why investors are not buying the dip in Adobe Stock. The link will be attached. The next company is Zoom Video Communications. Zoom provides video conferencing software used by businesses and individuals worldwide. The platform became essential during the remote work boom. In a SaaS framework, it's a system of engagement. However, switching costs are relatively low due to many competing alternatives. Zoom is trading at PE of 13, forward PE of 23 times, which means it is going to decline next year. Zoom valuation absolutely collapsed from 120 times and now trading at price to sales of less than 5, price to free cash flow of 13 times. Zoom exploded during the Rona, but video conferencing has low switching costs. Large platforms like Microsoft and Google bundle similar tools for free. The next company is Shopify. Shopify provides an e-commerce platform that allows businesses to run online stores. Merchants use it to manage payments, inventory, and logistics. In a SaaS stack, Shopify functions as a system of record for online commerce operations. As stores scale on a platform, switching becomes increasingly difficult. Shopify is trading at 121 times earnings and forward 52 times. Price to earnings growth of 2, sales multiple collapsed from 60 times to 13 times and currently close to historical averages. I'm ranking Shopify at B tier. Shopify powers millions of online stores and has a strong ecosystem, but e-commerce infrastructure could become increasingly commoditized. The next company is Intuit. Intuit develops financial software like QuickBooks and TurboTax. These tools help businesses and individuals manage accounting and taxes. In a SaaS framework, it acts as a system of record for financial data. Once financial history is stored in the platform, switching becomes extremely difficult. Price to sales corrected and currently is just 5.2 times sales, and price to free cash flow is 15 times free cash flow, comparing to 31 times historical averages. I would rank Intuit as a S tier. Intuit controls core financial data through products like QuickBooks and TurboTax. Accounting systems are extremely sticky because switching risks breaking a company's entire financial workflow. The next company is Veeva Systems. Veeva provides cloud software tailored for the pharmaceutical industry. Its platforms manage clinical trials, regulatory processes, and commercial operations. In a SaaS stock, it acts as a system of record for life sciences data. Its deep specialization creates strong competitive advantages. 30 times PE, 19 times forward PE, price to sales collapsed from 40 times sales to less than 10 times sales, sitting at 8 times sales currently, and price to free cash flow currently sitting under 20 times free cash flow. I'm ranking Veeva Systems as S tier. Veeva dominates regulated life science software where compliance and data integrity are critical. Pharmaceutical companies almost never switch platforms once they are embedded. Let me know in the comments if you disagree with any of the rankings. If you found this video valuable, consider subscribing to the channel. Thank you so much for watching, and I will see you in the next one.